thank you for joining the webinar today on relocating from the UK. I'm joined today by three other people. So my colleague Katie Shaw, who's a director in the private client tax team here at Moore Kingston Smith in London. We also have Giancarlo, who is from ASZ, which is an Italian member firm of our Moore Global Network. And we've got Birgitta, who is from Moore Stevens in Monaco, which is also firmed as part of our Moore Global Network. Just a couple of housekeeping points. So the session is being recorded, so we'll share the recording with you afterwards. And there's also a chat box for any questions you have. And if we've got time, we'll pick some questions to address today. Otherwise, we'll get back to you afterwards. Um, I mean, I'm sure most people who are on the webinar are familiar with the firm, but so we're Moore Kingston Smith. We're sort of part of the Moore Global Network, and Katie and I provide sort of private client tax services to individuals primarily, and similarly, Giancarlo and Birgitta do the same from Italy and in Monaco as well. So we thought it was useful to sort of run this webinar just because in the UK, as you know, we've had a general election in July and we've had a change of government. And in recent weeks, we've heard a lot of speculation in the press about sort of potential tax rises, and the Chancellor Rachel Reeves has also indicated that that's likely to happen. So we've been getting a lot of questions about that from clients, and one of those questions is from people who are considering whether or not, the grass is greener in a different country. So we thought it would be useful to have this webinar just to kind of give a bit of an overview about the sort of the rules around tax residence in the UK, and how all of that sort of could potentially impact individuals who are looking to leave the UK. Um, and we thought it would also be useful to have two people from alternative tax jurisdictions in Italy and Monaco to talk about what it looks like in their countries, just to give you a bit of a flavour of what else is out there and how that might compare to the UK. So I think we'll just start by just asking Katie just to sort of before we go into how you become non-UK resident for tax purposes, can you just explain, Katie, how an individual is taxed if they're non-resident and what that means in terms of their sort of income and gains?
Yeah, sure. Thanks, Joseph. So yes, that's a good place to start in terms of how is a non-UK resident taxed. So broadly, individuals who are not UK resident under the statutory residence test generally don't pay UK tax on their foreign income or on their foreign gains. So if you move from the UK and you realise income from overseas assets or sell overseas assets at a gain, then that income or those gains are not taxable here, as the UK doesn't have a taxing right over them. But if you have any assets remaining in the UK, such as UK property or savings and investment income, then a tax charge can arise. A common scenario is that you may rent out your main home when you leave the UK. And in that case, HMRC operate a non-resident landlord scheme, which means that the rent you receive has to have 20% tax deducted at source, and you get a credit for that when you submit your tax return. And usually it's the letting agent that deducts the 20% tax from the rent. But you can apply in advance to HMRC under this scheme to have the rental income paid to you gross with their approval. But that's just, a process that you have to go through. Turning to UK savings and investment income, another common situation here is that you might receive a dividend whilst you're overseas from a UK company, and whether that's in a private company or it's from an investment portfolio containing UK companies. And broadly, there's two choices here as to how you're taxed, but often the most common approach is to treat the dividend income as to what we refer to as disregarded income. That means that there's no tax payable in relation to UK dividends because tax on disregarded income is limited to any tax that's deducted at source, which in the case of dividends is nil. Other sources to watch out for are employment income. So if you carry on working for an employer after you've left the UK, so income from employment is generally taxable where you perform your duties, and it's not, say, where your employer is based or where you receive your salary. Therefore, if you do work in the UK, any salary that's attributable to UK duties will be taxed here. And practically speaking, it's generally based on the number of UK work days as a proportion of total work days in the year.
Okay, no, that's quite, yeah. So there's quite a range of sources of income obviously people have that have sort of different treatments. But what about capital gains? Because one of the big things that's been in the news recently is about potential increases to capital gains because it was one of the areas of tax that the Chancellor didn't rule out, or the Labour Party more accurately, in their manifesto. So what happens with capital gains if you're a non-UK resident?
Yeah, so capital gains are a bit different. So the general rule is that if you're non-UK resident, you can realise gains on assets situated anywhere in the world tax-free, unless they relate to UK land and property, because capital gains tax is based on residence and not necessarily the situs of assets, unless it's UK land and property. So if you sell UK shares or non-UK shares for that matter at a gain, then that gain isn't subject to capital gains tax. Therefore, business owners can exit their companies tax-free whilst they're non-UK resident, subject to any local tax considerations of where you're living. Um, but there is an important anti-avoidance rule. It's often referred to as like a 5-year rule that you've got to be aware of, that says that if you make a gain on assets that you owned before you left the UK and you sold them at a gain whilst you're non-resident, then if you return to the UK within 5 years, that gain could be taxable when you return.
Okay. So when you say 5 years, is that sort of 5 calendar years or is it UK tax years?
Yeah, that's a good question, Joseph. So the 5 years, so it's 5 years of non-tax residence as that applies to you. So you have to be non-tax resident for 5 years. And so it's not calendar years or tax years per se. So if you can split the year when you leave, and we'll come into split year treatment later, if you can split the year when you leave, it's 5 years from the date of that split. If you can't split the year of departure, then it's 5 years from the start of the next tax year.
Right.
But even so, when you leave the UK, you don't know necessarily when you're going to come back. If you think you might come back at some point, so you don't know if you will qualify for split year treatment when you come back. So therefore, to be really prudent, what we generally advise is that you should plan to be non-UK resident for 6 complete tax years, particularly in circumstances where you might realise a significant gain or draw down certain types of income, because certain types of income can be caught by this year rule as well, if you don't want that income or gain to be taxed when you come back to the UK.
Okay. So it sounds like if anyone sort of is leaving the UK and it's sort of tax motivated, it has to be something they're prepared to commit to for a number of years. So that's just something to be aware of, I
Yeah,
guess.
yeah.
Okay, so how about we go a bit more into what the rules are? So in terms of the statutory residence test, which you've referenced already, can you sort of give an overview of what the rules are, and explain how an individual can become non-UK tax resident under those rules?
Yeah, sure. So the statutory residence test, or the SRT that we call it for short, It's a very comprehensive test. It's set out in legislation and it enables taxpayers to determine whether they're tax resident or not. So before the SRT was introduced, all we really had was case law and guidance. But the SRT, it was introduced about 10 years ago, and it sets out a very objective test, but it's also quite rigid. So whilst it can give the taxpayer certainty, it can be quite constraining in some circumstances because there's minimal concession if you breach the rules. So you have to look at the rules very, very carefully. So the test, the SRT, it's got three parts. So the first part is the automatic non-residence test. And if you fall within that part of the test, then you're non-resident, and that's the end of the story. So for example, so the easiest way to be non-resident, if you've lived here, say up to now, is to spend less than 16 days in a tax year here, and you'll be non-resident, and that's the end of it. Once you've been non-resident for 3 years, that amount increases to 46 days. And in those scenarios, you're non-resident and that's it. You don't have to look further than that. If you don't fall within the automatic non-residence part, you move on to the second part of the SRT, which is the automatic UK residence test. And those tests determine whether you're automatically UK resident. And if you fall within that, you're UK resident, and that's the end of that story. So an example here is if you spend 183 days in the UK, you're automatically resident here. Another criteria is if you work what's called sufficient hours in the UK, and broadly that means working full time over a 365-day period with no significant break from UK work, then you're automatically UK resident. But obviously there'll be a lot of people who don't necessarily fall within those two automatic tests. So there's the third part of the test, the third and final part, and it's a tiebreaker, if you like. And this tiebreaker, it's called the sufficient ties test. And it looks at the connection factors an individual has with the UK combined with the number of days that they spend here. And that's where you determine whether you're resident or not. And there's a table, if you like, that sets it all out. And broadly, the idea is the more connecting factors you have with the UK, the less time you can spend here, and vice versa. So to give you an example, so let's say you've been resident here up to now, you want to become non-resident, you don't fall into the automatic tests, and let's say you leave and you've got three connecting factors with the UK. So that could be you've retained accommodation here, you've kept your home, you need to work here, say, for 40 days, and the other connecting factor is called a 90-day tie because you've been in the UK for 90 days in the previous 2 tax years. So you've got 3 ties with the UK. So to be non-resident, you can spend up to 45 days in the UK without becoming resident here. If those defined ties were more, so let's say you've got 4 ties, you could only spend 16 days here. If it was less, if you've got 2 ties, then you could spend up to 90.
Right, okay. It sounds quite complicated. So I think I speak to lots of clients who think it's like 90 days and that's, applicable to everybody. But from what you've described, it definitely isn't.
No.
And you need to look at sort of facts individually to work out what the position is for that person. Okay, that's quite interesting. So also, obviously in the UK, we have a fairly unique tax year that starts on the 6th of April and ends on the 5th of April. So it's very unlikely that, well, not very unlikely, probably unlikely that people would leave on the 5th of April in a year and then that's it. So what happens if somebody leaves partway through a year or even at the end of a calendar year? How do you work out what the position is for that sort of person?
Yeah, that's right, Joseph. Yeah, so you're unlikely to leave on the 5th of April. Most commonly, it's partway through the year. So the default position that you start with is that if you've been resident at some point in the year, you're treated as UK tax resident for the whole year. And that might not be great. Let's say if you leave, say in May or June towards the start of the tax year, and you're going to realise some significant income or gain in the rest of that tax year and you want non-UK resident treatment. But the default is you're tax resident for the whole year. But that's unless split year treatment applies. So split year treatment splits the year into the UK resident bit and a non-UK resident bit. But for people leaving the UK, there's only 3 cases in which split year treatment applies that's set out in legislation. The first is if you leave the UK to work full-time overseas, so you can split the year. The second is if you're the partner of such a person leaving the UK to work full-time overseas. But if it's not work related, the third case, and third and final, if you like, is where you cease to have a home in the UK. And there's some quite specific conditions attached to this, but generally it means that you have to give up your home. So, you rent it out or you sell it. And then once it's not available to you, there's only, I think, 16 days that you can then spend in the rest of the tax year. There's some other conditions around it. But broadly, if you're not leaving for a job overseas and you can't, give up your home, if you like, rent it out, then you won't be able to split the year and you have to wait until the 6th of April before non-resident status kicks in.
Okay, that's quite, I guess, useful for many people to know. So there is potential for you to have the non-UK tax resident treatment if you leave partway through a year. You just have to be sure that, you fulfill the conditions for those to apply. Okay. And then finally, so if you've made a decision, you've got advice, you understand exactly what you need to do you have to tell HMRC or can you just book your flight and go and then they just work it out based on, I don't know, immigration records or something?
Yeah, so you don't have to tell HMRC in advance. There's no need to do that. What you do need to do is if you submit tax returns, you just need to report it on the tax return for the tax year of departure. You complete the residence pages, and you also need to notify HMRC if you're claiming split year treatment. There is also a separate form that you can notify HMRC of your departure. It's called a P85. It's not mandatory, but it can be helpful for those individuals who primarily earn their income through employment, and it can help you obtain a tax refund of any PAYE collected at source, say after you've left. So P85 can be appropriate in some circumstances.
Okay, no, that's great. Just before we move to Giancarlo, Katie, we've had a question, which might be a question a few people have, so I'll answer it live, or you can answer it live. So somebody's asked, what about the UK state pension income? Is that taxable in the UK if you're not UK resident?
Um, yes, that's right. Yes, the state pension income is taxable. That's right.
Okay. And there's obviously treaties as well. So if you're tax resident in a different jurisdiction, that sort of income can be taxable primarily in the place you're resident. So that's something just to be aware of, where you have different sources of income that arise in the UK and then you become tax resident somewhere else. The rules around who gets to tax what depends on the treaty between the UK and the other country. And usually they would assign typically a sole or primary taxing right to a country. But effectively, you would end up in a position where there is no double taxation most of the time. But yeah, there's different treaties with different countries. The UK has quite an extensive treaty network, so it's just something that would have to be looked at depending on where you depend to move to as well. Okay, thank you very much, Katie. So I'll just move to Giancarlo, who is from our Italian member firm, and he'll just talk a bit about, what the tax landscape looks like there for individuals.
Good morning to everybody, and thank you very much, Joseph, and thank you very much to Moore Kingston Smith for inviting us today. Well, Italy does have options for individuals who wish to move their residence from a foreign country into Italy. And there are some very interesting options. Basically, we have 3 different regimes. One is a so-called flat tax for high net worth individuals. And the second option only applies to retired persons, while a third option applies to active persons who are active in employment or as self-employed. So we will shortly and briefly cover all the 3 options, starting with the first one, which is the so-called flat tax for high net worth individuals. This is a very interesting regime because it actually includes 3 advantages: a special flat tax for covering all your foreign income, a full exemption from inheritance and gift tax, which is, I believe, very important in most cases, and also an option to fast track your visa, your Italian visa, European visa. So what's in the package? Basically, if you opt to become a resident of Italy and move from a foreign country, you can opt for this special regime, and you will only pay a flat tax of 200,000 euros per year for yourself, plus eventually an additional 25,000 euros per year for each additional member of your family that moves along with you. This amount of 200,000 euros has been doubled during August, a few weeks ago. It used to be 100,000 euros per year, and it will stay in the old amount, in the previous amount, 100,000 euros per year for those who moved to Italy before August 10th, 2024. But from now on, it will be 200,000 per year. What are the advantages of this flat tax? You will be able to remit to Italy any foreign income without limitation, because that will not be taxed in any way in Italy. It will be covered by the flat tax. And you will be exempted from all tax monitoring obligations in Italy, and also from any wealth tax obligation in Italy on foreign assets and foreign real estate. You will still be taxed in Italy in case you have Italian sourced income, and you will be taxed on capital gains from the sale of qualified shareholdings during the first 5 years of opting for the flat tax regime. So we have a rule similar to that applied by the UK. You cannot exempt qualified capital gains during the first 5 years. They will be exempt after the first 5 years. But non-qualified shareholdings will be exempt starting from day 1. So there is no 5 years to be waited for. You also have an option to cherry pick countries that you want to exclude from the flat tax, and where you might wish to opt for the ordinary taxation regime to be applied, which means you would still pay taxes abroad, get the foreign tax credit in Italy, and then calculate any Italian foreign taxes if any is due. You can only be eligible for this regime if you have lived at least 9 years out of the last 10 years abroad, so outside of Italy. You also have an option to apply for a tax ruling before you move to Italy, to make sure that the application of the special regime is granted to you. This is not an obligation, it is just an option. And the benefits will last for 15 years from the first year. By the way, Italy applies a calendar year in terms of taxation year. So it's not like the UK. We tax from January 1st to December 31st. So if you opt to get into this regime, you can stay into this regime for a maximum of 15 years, but you are free to leave at any time. So you can opt out when you want to. There is a requirement to be actually a resident of Italy. So you must be resident of Italy. You must take up residency in Italy, and you must register with an Italian municipality as a regular resident, a permanent resident. You will be considered a full-time resident of Italy for double tax treaty purposes in any case. So you will become a regular tax resident of Italy. And also, as I mentioned before, you will get a full inheritance and gift tax exemption during the 15 years for any inheritance that you might leave behind, or gift tax or donations that you might decide to give to relatives or friends or wherever. The only assets which will be taxed under inheritance tax during the 15 years are Italian assets. So the exemption is full for all foreign assets. So I think that might be an interesting option. And also there is the option to fast track your visa for non-EU citizens. So a few words about moving residents to Italy and getting a visa in Italy. So if you are a non-EU, non-European Union resident, a citizen, and you decide to move to Italy, as a tourist, you may stay for 3 months without applying for a visa. If you, of course, like in this case, you move your residence to Italy, you would need to stay longer. So in this case, you can apply for what we call elective residence. And this would be a visa lasting for 12 months. And you have to be able to show that you have sufficient income to reside in Italy without having to work, and that you have a home in Italy. You don't need to own a home in Italy, but you can rent it. But you need to have a home where you can reside in Italy. So an elective residence visa would be valid for 12 months and can then be renewed year after year. And after 5 years, you can apply for a European residence visa, which would never expire and which would allow you to move freely in any European Union country and live freely as long as you wish in any European Union country. So this is the normal procedure, but you can also opt to fast track and make it much quicker. But there are certain conditions. You should decide to invest a minimum of 250,000 euros in an innovative startup business in Italy, which also might give you significant tax advantages, like a 30% tax credit. Or you should invest 2 million euros in Italian government bonds, or you should invest at least €500,000 in an Italian company, whether listed or not listed, it's the same. Or you should donate a minimum of €1 million in charity for scientific research, education, culture, and support of the arts, etc. But anyhow, I mean, in our experience, very few have opted for this fast track procedures because the ordinary procedure works quite well and everybody can get an elective residence visa quite easily, and it is very easy to manage. We do not specialize in immigration law. We have many lawyers in our firm, but we don't do immigration law as a specialty. But clearly, we can liaise with external immigration lawyers who might be expert in the cases that might arise. You may stay. Sorry. I think we already got this covered. So this was the first option, and the second option only applies to retired persons. It is also a very interesting option, but it applies to a limited part of Italy, only the southern regions, so not the north, not the center, only regions in the south of Italy, including the islands, Sardinia and Sicily, and only to people electing to move residents to towns and villages having less than 20,000 inhabitants in the south of Italy. So, to be honest, most of the favorite tourist locations in the south of Italy have less than 20,000 inhabitants, like Capri, the Amalfi Coast. Most locations in Sardinia or Sicily would have less than 20,000 inhabitants. But you have this limitation. You need to be a retired person. There is no age limit. So if in the UK you have become a retired person with 40 years of age, you're lucky and you can move to Italy and you can opt for this regime. But you need to move to the south and to a village having less than 20,000 inhabitants. The advantage you get is that all your foreign income will be taxed with a substitute tax at 7%, which is a huge advantage. Italian marginal rates in terms of personal income tax go up to 43%. So clearly 7% is a huge discount. And you can stay into this regime for 9 years. So that's also a considerable length of time. You also get a full exemption for tax monitoring obligations. So you don't have to declare any foreign held assets to the Italian equivalent of HMRC, and you don't have to pay any wealth tax on foreign held assets. You also have an option in this case as well to cherry pick individual jurisdictions abroad where you want to exclude those jurisdictions from the special regime. So in this case, for income originating from that country, ordinary taxation would apply. So you would be taxed in the foreign country. You get an Italian tax credit against taxes paid abroad. And then you would calculate any taxes due, if any, in Italy. Also, you can opt out of this regime at any time during the 9 years. So you're not locked in for 9 years, but you can decide to opt out after 2, 3, 6 years, whatever you like. So that was a second option. And the third option is what we call the impatriate tax regime. So it only applies to active workers, whether they are employed or self-employed, no matter, moving their residence to Italy. And in this case, you can get a 50% discount on your taxable income in Italy, up to a limit of 600,000 euros. So basically, it is not as convenient as the previous two regimes that I have described, but still, this is a sizable discount on any taxes due in Italy. If you consider that the maximum marginal tax rate in Italy is 43%, you would be paying a marginal tax which is maximum 21.5% in Italy on any income up to 600,000 euros. You need to be able to show that you have been a resident of a country other than Italy for at least 3 years before moving into Italy, and the tax benefits will be applied for only 5 years with no possibility to extend this. And also, this regime would only apply to people being able to show a high qualification or specialization. Generally speaking, a university degree would be assumed as showing high qualification or specialization. So these are basically the three options that are available to foreign residents who wish to switch their residence to Italy and enjoy the sun and other additional benefits beyond tax benefits. Clearly, it is very important that if you decide or you consider moving to Italy, you first check with our colleagues at Moore Kingston Smith whether you can, in first place, leave the UK, because as Katie explained before, the UK has elaborate and quite complex rules on leaving the country, like most countries might have. And then we can work together with our colleagues at MKS and make sure that you can safely and move to Italy in the best way possible, and you can enjoy all the benefits. We can work with you. Of course, we can help you transfer your residence to Italy. We can help you put in touch with the real estate agents who might be able to find you an accommodation. We can help you in managing the formal transfer of residence with the Italian municipality, and we can put you in touch with the immigration lawyer in case you have any special issue which needs special attention. And of course, we can deal with any Italian tax compliance which will be required in the years to come. But I'm very open to any questions which might arise. And I think we covered the 3 available regimes in Italy for the moment. Thank you very much.
No, thank you, Giancarlo. That was quite interesting. I think a lot of people probably hear about the lump sum taxation, but it's interesting to know there's alternatives as well for people. So yeah, I'm sure that would have been useful information for lots of people. We have got, a question or two, which we might come to at the end if we've got time. But now I'll just pass over to Birgitta just to talk a bit about Monaco and what the landscape looks like there.
Yes, so one of the things you asked me to comment on is the tax landscape, and it's quite easy and not terribly complicated because we do not have any personal income tax here in Monaco. There is no wealth tax, capital gains tax, no tax on distribution from trusts, remuneration as a director. All that type of income is not taxable in Monaco. What you have to think about, and as Giancarlo also mentioned, is that you have to then think about taxation at source. And here we can note that Monaco does not have a very extensive tax treaty network. So very often you will be subject to the internal rules of the country you're leaving. So if you're leaving the UK, what Katie talked about, how are you taxed as a non-resident, that will be the rule you have to follow for UK source income, for example. So there is inheritance tax in Monaco, but similarly to the flat tax regime, it's only Monaco assets that would be subject to that tax. And if the assets are passing in direct line, so between spouses, in direct descendants, then the tax is 0. So even there, even if you have a property in Monaco and you want to gift it to your children, it's 0 tax here. We have business profits tax, and but there again, it's quite nice because if you draw down remuneration from your business, obviously that is deductible from your profit, and as an individual, you will not get taxed on that remuneration. And I would say maybe that the ceilings for the business profit tax, the ceilings for the amount of remuneration you can draw down, they are quite generous. So that's a good thing to know. What I would say, so tax-wise, it's a nice place to be. But the type of clients I see, and we have seen a lot of interest for Monaco here at Moore Stephens, and it's not only the elections. It started before, I would say, for probably a year and a half, there has been interest in looking what should we do, because there has been an uncertainty, I think, in the political climate in the UK. And we have therefore a lot more interest. But it's not only a question of tax. And I think people are looking, and especially the high net worth individuals, they are looking to find a place where you have quality of life, because you are going to leave the UK, you're going to live somewhere else. You need to like it. You need to not just be there because you feel that you have to because you have just sold a business. And no, it has to be somewhere where you're going to genuinely like to spend time. So quality of life, good healthcare, good education system, speaking your language, and we speak the three main languages here is French, English, and Italian. So it's very cosmopolitan, and you can get on even with administrative tasks. People speak English, so that's a good thing. And I think also security is a very important issue for people who are looking to relocate. They want to be in a place where they will feel secure and where their children can walk home from school without being picked up necessarily. We're a small jurisdiction, we're a small country, 2 square kilometers, so very limited. But that is also very appreciated by the type of clients who are looking to relocate here. Stability also in how the tax environment and the political environment is going to be. And that is something you will find in Monaco. It's very, well, it's not going to change overnight because we don't have those political tensions or social tensions here as you might find in other jurisdictions. So those are the things that are important, not only the tax. But if you move to Monaco, and sometimes I hear clients, they say, well, how long do I have to stay in Monaco? And of course, you know, you shouldn't have that feeling, first of all. It should be, yes, I like to be there. But to apply for residence and to also qualify for retaining that residence status, if you are here more than 3 months a year, then you will have obtained a card, and also if you fulfill the requirements, of course. So but for someone who wants to point to Monaco and obtain something like an evidence of tax residence here, then you should think of spending 183 days here. There are other criteria such as center of activities and so on, but very often they go hand in hand with spending time in a place as well. And certainly here in Monaco, that's very much how the administrative police, because this is an immigration issue, they will look at time spent very much if they are to issue a tax certificate. But then this tax certificate is not always needed. And Katie, you mentioned, you know, you have in the UK, and this is what I've seen, and I admire this system because it's so clear. If you do certain things and you have taken advice, then you will know whether you're a tax resident or not. If you have respected the rules to stay out of the UK, then normally you don't have to provide the evidence somewhere else. I don't think there is any requirement in the UK that you provide, you know, evidence that you have moved your tax residence to another country. It's a question of just staying out of the UK or respecting those statutory tests. So the requirements for moving to Monaco would be that you have, well, it's 3 main criteria. You have to have accommodation here in Monaco, big enough for the people who are going to live there. You need sufficient financial means, and that would be either you have employment here, start a business, but very often what we see, and especially people who are moving now and they don't have all that already in place, they will come based on a bank certificate from a Monaco bank saying that the individual has sufficient means to live in Monaco without working. So that's very often how you prove that financial means test. Then finally, you have to be of good character, and that's evidenced by extract from the police records and the police will also do their own investigation. So those are the criteria to respect. And once you're respecting those, or you're fulfilling them rather, there is usually not a problem to renew your residence. And you will be issued with a 1-year card to start, then you go on to a 3-year card, and finally, after 10 years in Monaco, you can come into the privilege card, which is valid for 10 years. So yes, that's a little roundup of what happens here in Monaco. And what I would say also is this thing about stability, and we're seeing different countries where it's changing. Portugal, for example, recently changed. And of course, every jurisdiction that you want to attract high net worth individuals because they're good for your economy. So, but it's also political issues sometimes. And Monaco never had this, we need to attract people. It is an attractive place to come to. And we are not changing the rules just because something is happening somewhere else. So it's a stable country, and also we have a good public finances. So there is no need to go to the taxation for that income for the state. VAT is the biggest source of income for Monaco.
Okay. Oh, great. Thank you very much, Birgita. That's a very good point to end on, because stability is definitely something that our clients value. And as you've sort of mentioned, there is quite a lot of instability for a lot of countries, and it's largely politically driven. So it's useful to know that's something that, is available in Monaco for people who are more concerned about that. Okay, so we've got sort of roughly 10 minutes. So we've had some questions come through. So hopefully people have had a chance to have a look at those. So I'll pick one or two perhaps, and we had some before the webinar as well. So Giancarlo, there's one question I'm going to pick out for you. So somebody's asked if somebody's opted for the lump sum taxation regime, and they had, for example, sold shares in a UK company during the 15 years. What happens, after the 15 years if they decide to stay in Italy? Is there any chance of Italy deciding to tax that sale that happened while they were there, or is it completely certain that it would be out completely from Italian taxation?
You can be safe and certain. So if you have sold shares during your 15 years under the high net worth individuals regime, and you have received a flow of income that won't be taxed in any way after the 15 years. It can't be, because Italy applies a general rule when it comes to laws, that laws can only dispose for the future, which goes back to the ancient Romans, which is the basis of our law system. So well, now they can be taxed, but even in 15 years, it would be impossible for the Italian legislator to bring up a new law saying that your capital gains of 10 years ago should be taxed now. So because law can only change things for the future and not change anything in the past. So you can be safe that you won't be taxed in Italy on anything that happened during the 15 years and which was covered by the flat tax. Clearly, the idea of the Italian legislators in setting up this rule was to turn you into a permanent resident of Italy for the long time, in the long run. So clearly, it is meant to entice you to stay in Italy after 15 years.
Yes, that's quite good to know. So I've got just one more question for you, Giancarlo. You seem to be the more popular person to whom questions have been directed. So I'm going to pick one which I'm hopefully going to articulate correctly from what I understand has been written. So you mentioned about the sort of possibility to have tax rulings in Italy. So say you have somebody who is a non-EU resident, so for example, somebody who lives in the UK and they're thinking about moving to Italy, but they've got a particular set of facts they want to be certain will get the treatment they're hoping for in Italy. Is it possible for them to apply for an Italian tax ruling before they move to Italy, or do they have to be there already before they do that?
Yes, definitely. Anybody can apply for an advanced tax rule in Italy concerning the move to Italy, the transfer of residence to Italy under the high net worth individual regime. You don't have to be a EU resident. You can be a resident of any country in the world, and you're still given the chance to apply for an advance ruling. You're not required to apply for an advance rule and obtain an answer. You can simply decide to move to Italy and opt for the regime in your next tax return, your first tax return in Italy. If you wish to have certainty before you decide to move, anybody can apply for that. I'm also seeing a third question, a very quick one to handle. There is someone asking whether the option of moving to the south for retired persons also requires paying the 200,000 euros per year. No, there is no flat tax to be paid in this case. Retired persons moving to Italy, to the south of Italy, would only be paying 7% of their foreign income. If their foreign income is zero, they would be paying zero, but they only pay the 7% and no flat tax.
Okay. No, that's very, very good. Yeah, thank you for that. So just a question from before for Birgitta. So Monaco is obviously well known as a jurisdiction, and you've described kind of, what it's like. But in terms of the kind of people that would usually move to Monaco, do you see it being a particular, you know, high net worth individuals, for example? Can it be people who are professionals? What sorts of people do you think, or from your experience, typically speak to you about, moving to Monaco?
Yeah, we have both those who are coming, because Monaco, we need skilled workers, employees, and very often they might be from the UK. So we would help on those cases. What we're seeing at the moment is not necessarily a majority of that, but it's rather the high net worth individuals and ultra high net worth individuals. And it's not only the non-DOMs, those who are affected by those changes, it's also UK business people who are a bit worried, I would say, about what is going to happen and going forward in the UK. So that's really the thing, what we're seeing. And of course, when I talked about tax not being the only thing that you're planning for, it's also the geography of Monaco. We're right next to Nice airport. Well, Giancarlo, it's the same. Italy is not far away from the UK, but it's Europe somehow. But so you're not in Dubai or some other jurisdiction. You're in Europe, and that's, I think, a good thing and one of the important matters for people.
Okay, yeah, that's quite useful. Thank you very much. Just sort of picking up on that theme, one for Katie perhaps. So also we've got Giancarlo and Birgitta here. In terms of other sort of, jurisdictions that we see clients talking about potentially moving to, where would you say are sort of like popular areas that you hear a lot about from your clients?
Yeah, so broadly speaking, I think that low tax jurisdictions can be grouped into three different types, if you like. So you've got the well-known locations like Monaco, like we've been hearing about, the UK Crown dependencies, so Channel Islands, Isle of Man, maybe Bermuda, in some cases Switzerland, Cayman Islands, BVI, and these locations are generally viewed as the traditional low tax jurisdictions. And then you've got other places, secondly, which have become more popular in recent years. So perhaps Dubai or Singapore, with regimes to incentivize expats to move there. And then thirdly, I'd say you've got what are more the relatively new contenders who've designed specific tax regimes to attract individuals to the country, whether that's to invest in the country and spend money there or to attract certain professionals. In many cases, those countries are in Europe. And so Greece has a regime, Spain, many people might have heard of the Beckham law to attract certain individuals to Spain, Malta, Portugal. Portugal's been a bit more restricted recently, and Cyprus. But yeah, there's certain conditions attached to those, and quite often they are for a limited duration. But yeah, as we've touched on before, I think in my experience, clients usually have a strong feeling. It's usually quite visceral as to where they would be happy to move to. For some people, living on a small island might be attractive, or it might not be. So Guernsey, for example, a bit larger than Monaco, but it's 62 square kilometers. Or living in the Middle East, it might be attractive or not, as the case may be. And I find that's the starting point in discussions rather than tax rate per se.
Yeah, yeah, that's exactly right. Yeah, because these are life decisions ultimately. And while for a lot of people the tax is an important part of it, the life is also important. So finding the right place for you and for your family is probably of paramount importance. So we have had a few more questions, but we're sort of run out of time, so we'll try to get back to those questions after this webinar. But I just want to say thank you very much to everybody who's attended. Hopefully you found that useful as a starting point for thoughts you might already be having, or it might have triggered some new thoughts for you. But if you wanted to sort of get in touch with any of us afterwards, just to kind of explore a bit more about your own circumstances, we'll be very happy to help. And then thank you to Katie, Giancarlo, and Birgitta for their useful insights, which are really appreciated as well. So
Thank
yeah,
you.
Thank you very much.
Thank you.
thanks.
Thank you. Bye.
Bye.